Joining us right now to talk about the markets is Matt Powers with Powers Advisory Group. He's a managing partner there. Matt, you think that there is still risk to that market, and the biggest risk at this point is concentration in too few stocks.
Yeah, good morning, Becky. Thanks for having me. I don't want to come off sounding bearish because I'm not, and maybe kind of a cheesy analogy. I heard you guys have one here earlier. Not necessarily worried about the pie growing, maybe concerns about how it's sliced up. So the market's finally acknowledging how unsustainably top heavy the rally's become. And I still think the biggest risk here is concentration. Like you said, we're seeing investors stepping back from the most crowded, most expensive trades after more than 2 straight years of extremely concentrated leadership. And you could see it clear as day last week. Names trading at the highest valuations got hit the hardest. Investors started protecting gains. They moved towards value. So it's overdue. I think it needs to continue. And the story's been the same. It's, this is no mystery. A handful of stocks in the S&P, almost entirely mega cap names have accounted for almost 40% of the index and driven a lot of the returns. So when one of those names has a rough day, it's not just really, we don't see just that stock moving. It feels like the entire market's moving, and that's the environment we're in. Over 80% of the S&P names are still more than 20% below their all-time highs here.
Yeah, I hear your concerns, and that's certainly been a story that people have talked about for a while, Matt. Anybody who's actually made that bet, though, has not seen it pay off because those stocks may make up 40% of the returns, but they also make up a massive portion of the revenue. So if you're looking at them being overvalued relative to the rest of the market, there's still some questions about that.
Yeah, absolutely. I think Nvidia is maybe the biggest example of this entire dynamic here. So last week they delivered again. They beat and raised, temporarily put to rest this chatter of an AI bubble, and AI stocks bounced, sentiment kind of brightened up a little bit, and that flip didn't last long. So and that's the biggest issue to me here, I think, is how did we get? Truthfully, after 20 years of doing this, how did we get to a point where a single company's earnings call, it can dictate the entire tone for the market into, as we're heading into year end. If Nvidia had actually gone the other direction, which there's potential there, you'd be hearing we have a totally different conversation right now. So we built this.
No doubt.
Go ahead, sorry.
Well, no doubt. I hear you. We would be having a different conversation, but they did beat by a lot. They did raise. You're right. The stock reaction was weird. It would have been interesting to see what happened if they hadn't hit that. But I guess you're not saying you're writing this off. You're not saying you're negative about the markets. You just think that value is going to start to pick up, and those stocks that have been a little unloved are going to get more love.
Yeah, we're still bullish long term on the AI story. We just don't want clients, as we're advising clients and constructing portfolios, we don't want their retirement plan to be hinged on a single earnings call from one company or just a handful. And I just don't think that's a risk anyone needs to take, and we're taking a little more of a defensive position heading into year end. And there's this entire group of solid companies, dividend-growing companies. They've basically been ignored or overshadowed because of all the attention AI's gotten. And you're looking at steady earnings, much cheaper valuation, and I think that's exactly where you should be looking right now.
Okay, let's talk about the sectors and the stocks that you do recommend to your clients right now. One would be healthcare. Within the healthcare sector, you particularly like Abbott. Why is that?
Yeah, we're not chasing big yields or trying to hit home runs here, and these aren't quote unquote, you could say sexy picks. They're not supposed to be. That's the exact point. But when you look at Abbott, healthcare, this continues to hit our screen over and over. So I need to mention it, but it's a 50-year dividend grower. They've got expected double-digit growth on the device side, and they trade around for 24 times forward earnings, which is a pretty big discount to a lot in that medtech space. And they just did the acquisition of Exact Sciences, which gives them access to Cologuard and some diagnostic growth there. So just the kind of it's a high quality compounder, and you should want to own in a market like this with elevated valuations. And then Staples. Oh, go ahead. Sorry.
Yeah, Staples. You like Mondelez. The only thing I was going to say there is there are some concerns about the consumer. What makes you think Mondelez is safe from any potential crosswinds that could impact consumer spending?
Yeah, it's not just the consumer spending too at Mondelez. There's some headwinds with cocoa prices and some other things they need to be looking at. But they're a quiet compounder. The stock's off 2.5% year to date for the exact reasons we just said. But they're trading at 19 times forward earnings, and we like them because of shareholder yield, and they're committed to that. So that's dividends plus buybacks. They kick out 6.5%. of a shareholder yield, and they announced a new buyback program, so they're fully committed to that. And once investors actually start caring about valuation again, this would be a stock you'd want to look at.